You know, we hear all the time about the Fed raising interest rates to fight inflation. It's on the news, it's everywhere. But what if their most powerful weapon isn't really about interest rates at all? Today we're diving into some really cool research that suggests the real battle is for our minds.
Right, so we're all conditioned to think that the Fed's power comes from turning a dial, making it cheaper or more expensive to borrow money. But what if the real power is in their ability to shape our collective belief about what's going to happen in the future? That's the huge, provocative idea we're going to unpack today.
Okay, so to get this, we first have to understand the old-school traditional way of thinking about inflation expectations. For decades, the central idea in, economics and central banking was this thing called anchored expectations. Think of it like a giant, heavy anchor for the economy. The belief was that what people thought inflation would be way down the road, well, that belief was solid. It was stable. It didn't really move, no matter what crazy short-term news or policy changes were happening.
So if you're a central banker, your number one job was simple: protect that anchor. You had to keep those long-term expectations rock solid. In fact, if you saw those expectations starting to move because of something you did, that was a huge red flag. It meant you were losing credibility. Stability was the entire game.
But what happens when that anchor, that thing that's supposed to be so stable and helpful, gets stuck in the wrong place? Well, that's exactly the problem central banks have been staring down lately. Just take a look at this chart. That line shows you what professional forecasters thought long-term inflation would be over the last decade or so. And you can see it, right? For year after year, it's stuck consistently below the Fed's target. The anchor wasn't just stable anymore. It was basically stuck in the mud, and it was dragging the whole economy down with it.
And this created a massive headache for the Fed. I mean, the entire playbook was built on the idea that expectations shouldn't move. But now, all of a sudden, they needed them to move. They needed them to go up. It completely flips the script on how you're supposed to think about monetary policy. So this brings us right to the heart of the matter, the big question that the researchers behind this paper decided to tackle.
So on one hand, you have this foundational assumption of modern economics. Long-term expectations are fixed. They don't react. But these researchers came along and asked a really simple but kind of radical question. Wait a second. What if that's just wrong? What if policy does move our expectations? And what if that's actually a key part of how this whole thing works?
So to test this, they did something really clever. See, most previous studies had built models that basically forced expectations to be unresponsive. It was baked into the cake. These researchers, though, they built a model where they kind of took the handcuffs off. They allowed for a link between policy and expectations and just let the historical data speak for itself. They wanted to see what the numbers really said.
And when they did that, what they found was, well, pretty striking. It challenged decades of economic thinking.
All right, I want you to look at the chart in the bottom right here. This is tracking long-term inflation expectations. Now, the old theory said that if the Fed tightens policy, this line should stay flat. It shouldn't react. But look at what the data actually shows. It's not flat at all. There's a clear, immediate, and pretty significant drop.
And we're not talking about a tiny little wiggle here. The researchers found that these policy shocks from the Fed account for a whopping 16% of the movement in our long-term beliefs, like instantly. That's a huge direct link that almost everyone had assumed just didn't exist.
And hey, don't just take my word for it. The authors themselves put it perfectly. They say their findings are in sharp contrast with what came before, and that policy has a sizable impact on where our long-term expectations go. So much for that unmovable anchor, huh?
It definitely moves.
This whole discovery gives us a brand new concept, and they call it the re-anchoring channel. The big idea here is that monetary policy doesn't just work by fiddling with interest rates directly. It works by changing our minds first, and that change in our expectations then goes on to change actual inflation.
And this slide shows you just how powerful this channel is. All that red area you see, that's the part of the inflation response that's driven purely by changing our minds. So a huge chunk of the Fed's power to control inflation doesn't even come from the direct cost of borrowing. It comes from successfully shifting our collective beliefs. Without this mind-changing channel, their policies would be way, way less effective.
Okay, so this is a really big idea, right? But what does it actually mean in the real world? Like, how much did this really matter for the US economy over the past few years? Well, to figure that out, the researchers ran this amazing what-if scenario. They asked their model a simple question. What would have happened to the economy if, from 2012 onwards, the Fed had just ignored the fact that expectations were falling? What if they just stuck to the old rules?
And the results are, well, They're pretty dramatic. The black line is what actually happened. But that red line, that's the what-if world. That's what the model says would have happened. And just look at unemployment in that bottom right panel. It would have been so much higher. The economy would have been in a much, much worse place.
Let's just put some numbers on that. The model says that if the Fed had just ignored what was happening to our beliefs, unemployment would have been almost a full percentage point higher on average. Inflation would have been falling dangerously low. So the crucial takeaway is that by actively managing our expectations, by fighting to change our minds, the Fed likely prevented a much worse economic outcome.
And that leaves us with this really powerful final thought. What this research suggests is that one of the most important tools a central bank has isn't about spreadsheets and interest rate formulas, it's about communication, about persuasion. If our collective economic future is shaped this much by what we believe will happen, then maybe the great economic challenges of tomorrow won't be won or lost in the financial markets, but in the battle for our minds.